Uh, Good afternoon, everyone in Scotland and also the rest of the UK and wherever you are. So Ronnie, I think, is in Israel at the moment, so I'm sure some of you are overseas as well. Welcome to this event from the Asia Scotland Institute. My name is Martin Purbrick and I'll moderate the webinar today. Our focus today is a discussion of impact investing. Our guests, obviously, as you know, are Sir Ronnie Cohen, regarded as not a global thought leader, but I think the global thought leader regarding impact investing, the preeminent thought leader perhaps, and author of the book Impact, Reshaping Capitalism to Drive Real Change. And talking with him initially will be Stuart Langdon of Leapfrog Investment. If I could say just a little about Ronnie's background, and I think most of you will know him already, but there's too much to say. He's very accomplished. Sir Ronnie Cohen is chairman of the Global Steering Group for Impact Investment, which, to clarify, succeeded the G8 Social Impact Investment Task Force, of which he was also chair. He's the chairman and co-founder of the Portland Trust, the co-founder of Social Finance UK, US and Israel, the co-founder of Bridges Fund Management, UK, US, Israel, and the co-founder of Big Society Capital. Going back some years, in 1972, Ronnie co-founded what became Apax Partners Worldwide, and he led that firm as executive chairman until 2005. He served on many other prominent investment boards, including the Harvard Management Company and the Oxford Investment Committee. And obviously, as you know, or what he's most known for, he invests in profit with purpose companies and as an active global philanthropist, tackling issues ranging from one of the most difficult or troubling, perhaps, the Israeli-Palestinian peace building, to humanities and the arts. So quite a wide range. And I think Ronnie's motto, which he strives to live by, his daily principle, do good, do well, those four words would sum him up very nicely. So in discussion with Ronnie today is Stuart Langdon. Stuart is a partner with Leapfrog Investments. He's co-head of All Asian Investments with that firm, and I'm sure he'll say a little more about that shortly in terms of who they're working with. Stuart previously worked in corporate finance, investment banking, and capital markets advisory as a vice president at Rothschild, and specialized in sectors across Asia, Africa, and the Middle East. He completed Bachelor of Laws at the University of Aberdeen, my old home city, actually, Stuart, and began his career as an executive in the audit team at EY, before going on to qualify as a chartered accountant. And very importantly for us, Stuart is a board member of the Asia Scotland Institute. We also have our chairman and founder with us today, Roddy Gow, who's on the call, and we'll be asking some questions later. So could I just remind everyone, today we're on the Zoom webinar platform, so your videos and microphones can't be displayed, but only the panelists can be seen and heard. After the initial discussion, we do want to get to some Q&A and some interactive discussion, so please could you leave some questions in the Zoom chat function, either privately to me or publicly through the group if you wish, or put any comments up, nice comments please. And we'll get to your questions after the panel discussion. So with that, Stuart, could I hand over to you, please? And we'd like to kick off the discussion.
Thank you, Martin. It's great that we have both Harvard and Aberdeen, the two great universities of the world, represented on the call today. I think that's fantastic. Here is the book that we're going to be talking about, Sir Ronnie's book called Impact, which I would recommend to all of you, by the way. There are probably too many books on impact floating around the Washington shelves at the moment, but this is really the one that I think has all the key concepts in it, and it's also relatively short for those of you who are time poor. It's under 200 pages, so it really is a good way to get a handle on everything that's going on in what Sir Ronnie calls the impact revolution. So I recommend it to anybody. Ronnie, one of the things that's interesting as you go through the book is the parallel between your previous career in technology investing and how technology then went on to change the world, and what you see as this further change around impact. So maybe we should just start there. If you can just tell us a little bit about your own background and how you became so interested in the impact piece.
Certainly, Stuart. It's a great pleasure to be here with you, Stuart. Martin, thank you very much for your very kind words of introduction. And Roddy, it's great to see you again after quite a few a year. I became involved in venture capital, Stuart, we created what became Apex in 1972 because I felt it was a way for me to do good and to do well. At that time, Britain had a very large number of unemployed. Technology, entrepreneurship were ways of creating jobs. But as I saw my career unfold at Apex, I came to realize that while we had been backing entrepreneurs who came from very humble backgrounds to become wealthy and make wealthy those around them who worked with them, the gap between rich and poor was just getting bigger and bigger. And as I mentioned in the book, in 2000, out of the blue, sitting at my desk at Apex, I got a phone call from the Treasury asking me to look at the issue of poverty. And because I had been aware of these increasing social gaps, I immediately set to leading a task force. And that task force, the Social Investment Task Force, as it was called, reported after a year and basically said, where tackling social issues is concerned, it's amazing that we haven't found ways of bringing investment capital to fund those who want to improve lives. We've managed to do it for those who want to make money through venture capital and then private equity, but we haven't done it for those who want to improve lives. And that set me off on a path to connect social entrepreneurs and the capital markets. It took me to the invention of the social impact bond in 2010, which the team of social finance in my basement on Portland Place in London helped develop. Two young people came up to my office from the basement to the first floor and said to me, we've been working on the issue of prisoner recidivism. What do you think if we reduce the number and investors get paid accordingly? I said, wow, the idea of investing and getting a return depending on a social outcome that's been achieved is major. And that set me off to the G8 task force, which David Cameron set up. And there we discovered that the whole world was actually shifting in the direction of the social impact bond, meaning optimizing risk, return, and impact. And that's what the book is about, that actually, if you analyze the world today, you can see this paradigm shift taking place before our eyes in a similar way to the paradigm shift the tech revolution brought.
Yeah. And what I find interesting here is the language that you use in the book. I mean, you talk about an impact revolution that will get us to a destination that you call impact capitalism, which is, as you say, a big new concept. So tell us a bit more about that. What is the world of impact capitalism going to look like?
So I think if you look at the world today, Stuart, you can't but be impressed by the momentous change that investment is going through. I'm referring to the $30 to $40 trillion of ESG investment, which uses impact data in making investment decisions, and importantly, whose intention is to deliver more than just profit. And this is really revolutionizing, it has started to revolutionize investment portfolios. We begin to see companies like Tesla see their share price multiply by 7 in a single year. We see ESG ETFs outperforming normal ETFs. We see entrepreneurs coming forth with business plans that are going to improve health or education or help families to manage their finances better. And all of this today is based on intention. Only impact investment measures the impact created. And in my estimation, impact investment has reached $1 trillion now, from nothing 7 or 8 years ago. And that's equivalent to the whole of the venture capital pool in the world, by the way. So the measurement of impact is going to be the next frontier. By bringing the measurement of impact to investors and companies, at the time when we're beginning to see lots of people complaining about greenwashing, that ESG investing is going to change the behavior of companies, because when you have transparency on the impacts in monetary terms that companies create through their products, their employment and their operations, impacts on people and the environment, you begin to judge companies on the basis of both their profit and their impact performance, because it's clear that with the changing values that are driving this ESG investing, the world is going to be going to those companies that manage to optimize risk return and impact best.
Okay, but nonetheless, I certainly still encounter people who will say to me, you know, Stuart, the old style of capitalism has done pretty well for us. It's pulled a lot of people out of poverty. There's been a lot of economic development off the back of that.
Yeah.
The purpose of a company is to make money. You've just got to leave it alone. You still come across those kind of Milton Friedman acolytes. What do you say to that? How do you respond to people like that? When you...
So I say to them, look at the data at Harvard Business School's Impact Weighted Accounts Initiative, which I'm privileged to chair. We have already published the environmental damage caused by 1,800 companies. These are public companies that have made information available about their environmental impacts. If I say to you that 250 of these companies deliver more damage in a year in monetary terms than they do profit, that 600 deliver 25% or more of their profit in environmental damage, that together they deliver $3 trillion of environmental damage in a single year, and that there is already apparent a correlation within certain sectors between lower stock market valuations and higher levels of pollution, then you have a peep into the future, Stuart, don't you?
And I mean, you've gone straight towards impact weighted accounts, which I think is one of the, I mean, that is one of the really big concepts in the book. One of the things that really kind of made me sit up and take notice as I was reading through it. So let's just talk about that. You've been involved in a lot of different measurement activities that have kind of led towards the impact weighted accounts. Tell us a bit about how that whole area of thinking, the measurement of social impact, how all of that works.
Well, the need for it is apparent in this whole debate now around claims that are being made about delivering green impact, which are being proven to be unjustified. And there are lawsuits taking place in the United States and elsewhere about misrepresentation by companies. So clearly we need transparency. Mm-hmm. Now, the efforts to which you referred, Stuart, over the last 3 or 4 decades around environmental impact and lately around social impact as well, had tended to concentrate on the metrics, the tons of CO2 in the atmosphere. The Harvard effort is taking the best metrics and then creating pathways to monetizing them. So it's taking a price for a ton of carbon from all of the data that is, that is available, as an example. And then it's creating a framework for measuring all of the different impacts created through the operations of a company, what's known as its environmental footprint, through the employment of a company, and through its products. And these impacts aren't just on the environment, they're on people and planet. And in my view, Stuart, this is the future, and it's going to come within the next 3 to 5 years. Transparency on the impacts of company through impact accounting, because it's the only way for us to be able to compare companies on a dependable basis, where the numbers have been established on the basis of the same principles and have been audited.
Yeah, and I guess, you know, if I was an analyst sitting at Baillie Gifford or Aberdeen Standard or any of the other great Edinburgh fund management houses, what you would advise me to do based on what the book is saying is add this impact dimension to your framework for looking at companies. And what you'll find is that some are much less sustainable than others. So there's a real, it's in your own interest to adopt this. This is not some sort of social initiative you're trying to push down people's throats.
Yeah, I mean, about a decade ago, people disputed whether coal companies really faced the problem. And now if you look at the valuations of coal companies, it's become apparent that those who tarried as investors in them lost a lot of money. At the same time, if you look at the clean energy indices, they shot up. So this is good investment sense. And we're going to see a disruption from impact, a disruption to investment portfolios, similar to that which came with the arrival of technology.
Yeah.
So we're going to see companies like Tesla entering old established industries as new entrants, not because these are simple industries in which to make money, but because they have a desire to shift the industry to a more positive impact. Yeah. And these companies will disrupt the models of their competitors, and the competitors being the existing companies, the competitors are going to have to adapt to new models, shifting to electric vehicles, or basically be left behind in the dust.
Can we just double click on something you touched on earlier on, which is the distinction between ESG and impact, which clearly goes much beyond the ESG piece. I think a lot of people, when they hear impact, they kind of go straight to ESG and they kind of think, yeah, well, you know, I'm ticking all the boxes on ESG, so I'm trying to do the right thing here. Can you just help us unpack a little bit more about why what you're talking about goes so far beyond what there is today on the ESG front?
Yeah, I think ESG has the intention. But intention is not sufficient, because intention is measured very qualitatively, very vaguely, on the basis of the information that's made available by companies, which is often a very selective basis, focusing on the good rather than, you know, the harm that is being caused. Impact investment is defined as having intention to create positive impact and measuring the impact created. Now, ESG didn't have the tools of private equity in measuring impact. Private equity often had single product companies, and so you began to find funds like TPG and Bain and Partners Group in Europe, Blackstone, now Apex, coming out and saying, we're going to measure our impacts, the impacts of our portfolios, as well as our profits. But ESG didn't have the ability to do that. And it's only now that we're realizing that breakthroughs in technology and big data enable us to measure the impacts of companies almost as dependably as we measure their profit, and much more dependably than we measure their risk. And so the efforts of regulators now to share this impact data fairly among all investors are going inevitably to take us to a single set of globally, or hopefully globally accepted, generally accepted impact principles and audited numbers.
So let me just ask you about one person who you cite a couple of times in the book is Emmanuel Faber, the CEO, as was Danone, who I'd met a couple of times myself. Fantastic guy, huge proponent of more than ESG, really the whole impact piece. The idea, I think he turned Danone into a purpose-driven company. Really did everything that you or I could possibly ask for, and then found himself removed because performance, as investors perceive, performance has suffered as a result. How should we think about that? Do companies pay lip service to this impact piece, and then when the going gets tough, it's back to old-fashioned capitalism?
Look, it's a good question. In fact, as we speak, I think Le Monde is publishing in its digital version an op-ed by my two colleagues at Harvard Business School, Professor George Seraphim and Assistant Professor Ethan Ruin, and myself, based on the Danone case. And I think this is very instructive, Stuart, because the board of Danone, under pressure from activist shareholders who were dissatisfied with the financial performance of the company and thought that this whole impact lark was a distraction, got rid of Emmanuel Faber, who had been insistent that the company needed to move in a more impactful direction. They made their decision on the basis of financial information without any knowledge, in my view, or little knowledge of the impact of the company. Now, if you go to the Harvard data, which is open source for everyone to see, you just go to HBS and then look for IWA, impact weighted accounts, you'll see that Danone is actually a negative impact company, meaning by this that its products deliver $8 billion of negative impact on health because of their sugar content, relative to $5 billion of earnings before interest, tax, and amortization and depreciation. So on the basis of its product impact, obviously it also has positive employment impact, and its operational impact is somewhat negative. But you can see that it lags Nestle and General Mills in terms of its product impact. So had the shareholders of Danone been aware of that, they'd have asked themselves the question, are we really getting rid of the person who is best placed to make this transition for the company to positive impact? Because if he is, this is the way to avoid seeing the valuation of our company reduced significantly as all of this impact data comes into current use.
So, I mean, one of the things we're kind of touching on here, I think, is probably the question I get asked more than any other about impact investing, which is there a trade-off here? If I have to adopt all this impact stuff, will my profits suffer as a result? And we've been very consistent at Leapfrog in arguing that certainly our business model is one where there is no trade-off. How do you answer that question these days? Do you see real data that suggests that there isn't a trade-off between these things, or do you think there is a trade-off that we just have to accept and start to manage as a society?
So I think you see evidence in in some business models, and we can go into some examples, that are capable of delivering both impact and profit hand in hand. I can give you an example I mentioned in the book, a very high-tech artificial intelligence-based pair of spectacles that helps blind people to see, in inverted commas, by whispering into their ear the pages of the book they're holding, or the envelope in their hand, or the banknote, or whatever, beautifully spoken into your ear, multiple languages, and so on. Now, that's helping 35 million blind people and 250 million visually impaired people. So profit with purpose, no conflict at all between the two. But more broadly, what we're discovering is that it would be very stupid for us today as investors to invest in a company which is creating very real negative environmental or social impact. So we're beginning to realize that investing through an impact lens actually reduces the risk of a business, improves the quality of its future earnings. At the same time, it helps you to redefine your market in much bigger ways very often. So if you take the example of Orcam, and you think as an impact entrepreneur, as you do at Leapfrog, you ask yourself the question, how can this technology help the maximum number of people? And you get a surprising answer, which is, what if you could provide these spectacles to the 800 million illiterate people in the world?
Mm-hmm.
You know, what would that do for their lives and livelihoods? And for the company, it becomes a 1.1 billion person market. So I think there are plenty of reasons as an investor to go in the direction of impactful companies that have models capable of delivering both positive impact and profit.
Yeah, and you've given some good examples there. And I think one of the things that's great about the book is it kind of does the very high level theoretical stuff, but it also gives a lot of good examples of impactful companies that you talk about. I guess, I mean, one of those that's most closely associated with yourself is Bridges and all of the success that they've had. Would you mind telling us a bit about Bridges and how that idea came up and what you've been able to do there?
Yeah, thank you for asking. I mean, Bridges, like Leapfrog, is an impact fund management organization. Immediately after the Social Investment Task Force, Michelle Giddins, who had been my right hand on the task force, and I sat around my desk at Apex and discussed that the obvious thing to do after the report of the task force was to create an investment management organization that would focus on investing in the poorest parts of the UK, the 25% most disadvantaged parts of the UK. There's an index of deprivation, and so these areas are easily identified. Now, if you fast forward nearly 20 years now, you can see that the returns that Bridges has achieved have actually been market rates of return, while its investments have gone to the poorest 10% of the UK, just because that's where the opportunities were. And so Bridges and Leapfrog, in my view, set the new normal for investment. Within the venture capital and private equity industry, as we were saying, it's been easier to measure our impacts. And so Bridges and Leapfrog are two organizations that are focused on, on doing that as well, giving investors a sense of both performance at a profit level and at an impact level, which is where the whole world is heading now, as we were saying. If we get transparency on the impacts of companies expressed in financial terms, $40 trillion of ESG money, equivalent to a third or more of all professionally managed assets in the world, is actually going to have the data to make informed decisions about which companies deliver impact and profit, and what the correlation is between being more impactful and being more profitable or growing faster in the future.
Yep, and the private equity model of impact investing, I think, has really taken off. You talk also in the book about social impact bonds. You touched on those earlier on. You mentioned to me yesterday now something like 210 social impact bonds in the world. So that's another area that's really gaining traction. How do you see the outlook there?
I think that's rather an interesting instrument, because I see the social impact bond as an absolute return security, meaning by that it's uncorrelated with the stock market or even with interest rates, because your returns are dictated by your ability to achieve an improvement in education or in health or unemployment or homelessness or whatever, with terms set in the contract that say, if you help so many people get off the street who are currently homeless and they stay and they get into jobs, or you get paid so much, either by government or by aid organization or philanthropist, or a combination of all three. These outcomes-based approaches are much more effective than traditional philanthropy has been.
Mm-hmm.
What we can see is that they give a growth path to the entity receiving this money, which is often a charitable entity. Because if you can pay between 4 and 10% on a social impact bond, which also improves the lives of people, then that has a place in your bond portfolio.
Mm.
You know, if you can have an absolute return of about 5-6% in today's world, you know, how much of our portfolio should go into that?
Yeah.
And I think the effort to date has been on piloting in 35 countries, dealing with 15 different social issues. But as you were saying, Stuart, with 210 pilots averaging $3 million or so each, we have enough information about what works. Mm-hmm. And we are therefore in the position now to scale this with impact bonds for education in Africa and the Middle East, you know, for instance, where UBS and Bridges are in the process of launching an education impact bond fund. I think we're going to be moving in the direction of pay for success. Mm-hmm. For one thing, it forces, just as a venture capitalist does with the business, careful consideration of the best way to achieve the desired social or environmental outcome. The generation of data so that you can define the best way and track performance. And then, very importantly, for the organizations that are successful in paying a 4, 5, 6% return based on real social improvement, it gives them a path, like a business, to raising much more money in the future.
Got it. So one final question from me then, and I know there's a lot of other questions from people who are watching. There's a lot of people on the line here who are interested in impact. They want to go and do things in the impact world. They might be relatively unfamiliar with some of these initiatives we've talked about. Yeah. What is the advice you'd give to people on how to get more involved, or perhaps even what are the 2 or 3 things you'd like to see happen next in the world of impact to take it to the next level?
Okay, well, so Stuart, as investors, it behoves us today to get as much impact information as we can about our portfolio companies, yeah, and to identify those that have a problem in terms of negative impact, and to engage with their management and find out whether the management's prepared to go in the direction of positive impact, or whether they're stuck in the mud and think all of this is somehow going to blow away. And I think investors will disengage from the latter and will engage with those who are sincerely trying to transition. And I think transition plans are going to be part of our lives for a while now, both for a transition to net zero, but also transitions to greater diversity, equality of income according to gender, and so on and so forth. But then below that, as employees of a company, as talent, as executives of a company, we have a major role to play in spreading these ideas and implementing them. And finally, as consumers, we will soon have apps that have the Harvard data on them, that enable you to scan the barcode of a box of Twinings tea and see that Associated British Foods makes $1.6 billion of profit, but delivers $1.8 billion of negative environmental impact in a year. And that's going to affect our purchasing decisions.
Mm-hmm. So everybody has a role to play, consumers, everybody from the top to the bottom of organizations, that's clear.
Exactly.
Okay, Martin, I know there's questions coming in thick and fast. So shall we move to those?
Great, thank you very much, Ronnie. Stuart, thank you very much for that initial discussion. We have quite a few questions, but could I hand over to Roddy first? I think you have something to ask, Roddy.
Oh, thank you. And Ronnie, what a very interesting discussion this has been so far. We earlier this year had, last year, Jacqueline Novogratz to come and talk, who you will know, the Acumen Fund, and she was looking at microfinance. But dealing with some of the issues that we confront in the world, I flew in from the United States 10 days ago, there people's fear about the changing demographics of a country are very evident at the moment. And I wondered if you'd thought about or have a view on what can be done to combat some of the racism that we see in that country. And I'm just mindful of the recent book written by Isabel Wilkerson called Caste. Because the problem is in the United States of America with Black Lives Matter and other minority groups which will become majorities. And of course in India with the caste system, which again in that country is clearly a barrier to reaching their full potential.
So Ronnie, these are very important issues many countries face, and you could say that the world faces. What impact measurement can do is to change the behavior of companies in the direction of greater diversity and of equal pay and representation of minority groups within the business that correspond with the demographics outside the business. And I think if we begin to provide transparency on this, we not only create peer pressure for companies to compete with the best in their sector, because they're going to be favored by investors if they perform better. But we also give companies the tools to be able to improve this. Lots of business leaders think vaguely about these types of issues and feel sympathetic to the idea of doing something, but they don't have the numbers to be able to judge the scale of the problem and its a specific location within the business. Now, can this eradicate racism? No. Racism is a psychological phenomenon as much as as anything else. But if we can bring companies to the side of governments in tackling these big social challenges, as well as our big environmental challenges, instead of a current system, which is why I talk about reshaping capitalism, where companies actually in their search for profit are creating these problems and sometimes aggravating them if they haven't created them, then that's a huge change. That brings our economic system to delivering solutions rather than problems.
Thank you.
Ronnie, thank you very much. Perhaps we could go to some questions from the audience, Ronnie, if you don't mind. Quite a diverse range of questions, so excuse me if I sort of jump between topics a little bit. But firstly, from Hazel, who's asked something that I think is sort of resonating in much of the discussion and comments from the audience, which is about structure. And Hazel asks, one main obstacle for universal ESG adoption is the lack of a concrete framework or frameworks. Are you positive that a universally accredited ESG framework can be constructed in the near future? And what is your advice on the construction of such a framework?
Wow, Hazel, that is the million-dollar question today. We have seen regulators in the form of IOSCO, which brings together all the world's regulators, saying we have to look at impact transparency because investors are making decisions on the basis of inadequate data, incomparable data not shared at the same time by all investors and so on. This is having two impacts. It's having one impact in the US through the SEC, where the new commissioners appointed by the Biden administration making the right types of noises about, we have to tackle this. And then it's also being reflected by the decision of IFRS, the International Financial Reporting Standards Foundation, which is responsible for all financial accounting outside of the US, to establish a new Sustainable Accounting Standards Board. Now, there's no doubt that it's possible to arrive at generally accepted impact principles, but the question you're raising is a very important one. If we want to avoid the schism that exists today between GAAP accounting and rest of the world accounting, which means additional costs for businesses and complicates the lives of management, then we have to try to arrive at a single set of global impact accounting standards. And to do that means that there has to be cooperation between the EU and the United States and IFRS. And if we can manage to do that, and I think it's going to happen this year or not happen, if we can manage to achieve that, then it'll be a very big step forward. But either way, we will get to impact transparency. If we have two somewhat similar systems in the US and the rest of the world, so be it. But I really would like all of us to make every effort we can to establish a single set of impact standards.
Thank you very much, Ronnie. Just staying with that theme a little bit, not so much on structure of standards, but perhaps on measurement. And we have a very interesting question from actually someone who prefers to be anonymous, but how would you compensate the different characteristics of each industry? Since, for instance, positive impact to the environment are easier in some industries than others. And is it fair to compare the impact at the same level with a transitioning sector and an already green sector? So I think that's coming back to this question of measurement and structure. Could you comment on that?
Yeah, no, so there's no doubt that electricity generation is hugely impact negative, construction industry is hugely impact negative, and the airline industry is impact negative, or no, not as hugely as all of you know, the ones that I have just mentioned. I think, Martin, if we have transparency, then we can begin to think as management of these companies and as investors. We can begin to think of how do we address these and what are the implications for our portfolio. Now, clearly, we can't do without air travel. But if all of a sudden an airline begins to use clean fuel, wouldn't that favor investing in it rather than its competitors? Might not, therefore, its value increase more than proportionately? And might it attract more travelers because of it and develop a competitive advantage as a result of it? And so I think you have to look across industries and decide what appeals to you, you know, as an investor in terms of a combination of profit and impact. And then within your selected industries, you have to look at the companies that are doing the best job of optimizing risk, return, and impact. But there's no doubt that the transparency and the arrival at a bottom line which is affected by your impact is going to drive businesses in the direction of rethinking, in many cases, their business models in order to create positive rather than negative impacts, just as the example I was giving with Danone suggests.
I think I should ask you something a little easier rather than structure and standards and implementation, because I think you're setting the thought leadership, and you shouldn't be the person who's asked how you do it in great granular detail. I think that's always on everyone's mind. I have a question from Wendy Wu, and Wendy, I think, is from Napier University and herself very active in in this area. And Wendy asks, in your book, you discuss the social investment bond model. So what are the challenges facing that model and how can they be overcome? A little more straightforward, I hope.
Well, the big complaint today about social impact bonds is that they take quite a lot of work to put in place. You have to find an investor or a series of investors, and those are becoming very numerous now. But you have to find somebody to pay for the outcomes achieved, the government, aid organizations, or philanthropists. And until you have big outcomes funds, professionally managed outcomes funds, such as the $1 billion fund. I shouldn't call it a fund, it'll confuse you, but a pool, $1 billion pool to pay for the outcomes achieved in education in Africa and the Middle East by charitable and profit with purpose businesses that enter into contracts with the outcomes fund and are funded by investors through the UBS Bridges type of fund. Until we arrive at that, we're sort of handcrafting every impact bond. But I think we're on the threshold of that, Wendy. And it's all about scaling now. And I believe we're moving to a world where we're going to see professionally managed outcomes funds, not just for education, but for health, for employment, for reskilling, for homelessness, and many other social issues. And investor appetite, which was non-existent, obviously, when it was invented, investment appetite seems to have grown and really outdistanced the availability of outcomes funding.
Thank you very much. And thank you, Wendy, for that question as well. Ronnie, as we're coming up quickly to the end of the hour, that there's a set of questions from several people that I'd like to put to you, which is a bit more tricky perhaps, but I think most important. And excuse me if I just read several of the questions because they're on the same theme. So firstly, from someone in the audience, most of the experts you've referenced so far are men. How do you think we can make the world of impact investing more inclusive for women and minority groups? I think Roddy touched a little on this as well. And then from several other people who've joined our events in the past, how will Ronnie explain the impacts in terms of gender equality, women's empowerment, and how to eradicate illiteracy from economically poorer countries? And then lastly, but still on the same theme, while you think this through perhaps, how is it possible to have change with the same people still being in power? So I think the subject of diversity and gender equality is something we come back to in many events recently, Roddy, and it's increasingly important in this country and in several other countries, but not every country, obviously, depending on the openness of society. So could you say something about this? Is what you advocate possible in the structures that are in place around the world?
I think it is essential to it, but not sufficient. What do I mean by that? In dealing with the issue of gender inequality in companies, we're talking partly representation, so the presence of numbers of men relative to women, and we're also talking differences in pay and advancement. Now, these three variables are actually capable of being measured separately and monetized. And in the next few weeks, and certainly a month or two, we will be publishing at Harvard the employment impact of 3,000 companies, measuring gender inequality, differences in pay, advancement, diversity, ethnic diversity, and so on. Now, will that be sufficient? Well, I've just come from a meeting with the head of Microsoft's R&D operation here in Israel, who is a woman. And we were talking about what needs to be done if we want to see more women participating in leading tech firms. I'm proud to say that my own family's investment activities resulted in our backing the first woman to lead an Israeli unicorn, a company called Papaya, and a wonderful woman entrepreneur called Einat Getz. And the answer is, it needs to start early on in their education. And they need to be prepared to assume leadership positions, to take risks, and to go for subjects at school that put them on the path to leading a major tech venture. So the transparency is essential for us to be able to create the peer pressure and to give management the tools to act. But we have to begin to treat women from their birth as the equals of men with same aptitudes or better aptitudes and able to follow the same careers. There's no doubt that just talking about it without data about specific companies' performance isn't going to get us there. On the issue of illiteracy, I believe that the $1 billion Outcomes Fund can educate 10 million children in Africa, paying for the outcomes, funded by investors who are funding the delivery organizations for it. I would like to see 80 of these outcomes funds of $1 billion each across the world. It would enable us to tackle the 800 million kids who are not learning, whether it's at school or out of school. And then to the question of, can you really expect change with the same people in place? They won't be the same people in place if you have transparency. There are some people who understand this, just as there were some people who understood the impact of technology on their business. There are some people who understand the thinking around impact and its importance for the firm, that it is the way for them through greater diversity to deliver better performance, and who are capable of, implementing this. And there are others who, as happened with technology, think this is all a load of fluff and nothing's ever going to come of it, and so they should persevere. But if you begin to measure the impact performance of a company, you can measure the impact performance of its leadership. And if the leadership is wanting, well, you'll do what happens when leadership is wanting in delivering profits. When they don't deliver the impact and the profit, then you'll change the leadership.
Thank you, Ronnie, for answering a delicate set of questions very eloquently, I think, and a complex set of questions as well. If I could go back a little bit to strategy, and I have a question from Guy Jubb, who has a long career involved in governance. I think you've made a...
Sure.
Yeah. So Guy has asked, you encourage disengagement, but there is a major role for investors in getting companies to change their strategies to address their negative impacts and achieve positive impacts. Disinvestment is walking away from the problem and arguably is irresponsible. That's rather a challenging statement from Guy, but perhaps you could say something about that.
Well, first of all, you have to know that Guy and I go back to the early 80s or soon after, when he was at Standard Life, if my memory serves me right. So wonderful to be reconnected, Guy. I think the issue of engagement versus disengagement depends on the management of the company. I think investors are going to want to see returns. And if a company is following the wrong strategy with regard to impact and it's going to impair the value of the company, they're not going to persevere, most of them. And they're going to shift away from it. They're going to engage with those who want to go in the right impact direction. this will create pressure on the share prices of those who persist in creating negative impact, reduce the value of their companies, and they'll get shifted out of their positions. I certainly don't believe that we can disengage from every company that is creating some harm in the world, because in the absence of measurement, almost every company is creating a combination of good and harm. But I do think where we're heading, Guy, as we saw with the recent Procter & Gamble shareholders meeting, is in the direction of transition plans. What happened a month or two ago is that 2/3 of shareholders of P&G voted against the management because of the deforestation P&G's use of palm oil has been creating. And the shareholders demanded more data and demanded a plan from the company to reduce this accelerating deforestation. And I think we're going to find shareholder pressure increasing for environmental and social issues, and constant requests for transition plans from companies, which may end up having to be approved by shareholders.
I'm glad we've reconnected you with someone. And speaking of which, as well as rather a lot of questions, which we can't all get to, I'm very sorry, everyone, that there are rather a lot of questions from people to connect with you separately. So I have pointed people to your website, and there's a contact point there. But in fact, someone has just asked if you could do another talk. So I'm sorry, Ronnie, you're in great demand. But could I just ask a closing question and put this back to Asia, if I could, because we're an institute that focuses on Asia. Is there a danger with this concept of dual systems emerging? And we're already seeing a danger of dual track economies with the political conflict between the USA and China. Is there a danger of, for example, in Asia, a set of economies not adopting these principles, but being rather insular themselves, and elsewhere economies adopting these principles, and then the dual tracks emerging? Is that a risk?
I don't think it's a big risk, Martin. And one interesting signpost to why it's not such a big risk is the Temasek decision. As all of you know, it's a government-owned company in Singapore, $400 billion under management, extremely influential in Asia because it's a thought leader. And Temasek decided to invest $500 million in the Leapfrog Impact Fund. $500 million from somebody like Temasek says, this is the future norm. This is the future norm. And I think even in countries where previously we have seen real pushback against slowing the pace of industrialization because of pollution, we've seen pollution achieve such a scale and create so much harm that the largest number of electric buses is in China today. You haven't had any coal-fired electricity generating stations in India for 5 years. So countries are aware of this, and I think this is going to be just like technology was. This is going to be a new paradigm of risk, return, and impact.
Thank you so much, Ronnie. I'm absolutely touched by our comments, actually, and moved by them. It's far more motivating than just reading the book, but we're also encouraging people to buy and read the book. And with that, Roddy, could I hand back to you, please?
Yes, Martin, thank you. And it falls to me, Ronnie, to thank you so much for joining us today, and to Stuart for helping make it happen. When I think of impact investing, I think of sort of an investment approach, which is instead of throwing a bucket of water at a problem, it's directing a narrow gauge hose with water that flows and hits the target. Our involvement with Asia means that we're dealing with countries in significantly different states of development. Myanmar obviously being one, Thailand another, China itself. The question is, will Singapore freeze the assets of the leadership in Myanmar? We shall see. But you've given us a terrific overview of what you're doing. Of course, you'll speak again because we'll get you back up to Scotland, or get you to Scotland when the COVID pandemic is over. But I know, speaking for a lot of people who've been listening to your remarks and to Stuart's interview with you, this has been an extremely enlightening discussion, which frankly leaves me, as Martin has said about himself, a great deal more optimistic about the ways in which the behaviour of individuals and corporations can be affected. So on behalf of the Age of Scotland Institute and all your fans here north of Hadrian's Wall and elsewhere in the world, thank you very much indeed, Ronnie.
Great pleasure. Wonderful to be with you all. All the royalties from the book are going to Impact Charities, and it's the easiest way for us to spread the thinking about impact. Thank you.
Thanks, everyone.
Very much.
Thank you. Goodbye.